Hey, thank you, Kevin. That's awesome. Great intro. Hey, everybody. My name's AJ Brown. As you can see uh, on the picture here, what we're going to be talking about today is something that's really congruent with what's happening in the market right now, despite us kind of tickling a level of resistance that we've tickled 3 times before. We're in a sideways, choppy market. Hey, I've been trading options since 1997, and I've been doing options full time as my only source of income since 2005. I founded this group called Trading Trainer, which is kind of a community of traders that gets together and talks about this stuff. And I wanted to, you may or may not know me. In fact, let me ask you, you've got your hand raising mechanism. Even if you've gone ahead and shrunk down your webinar control panel so that you free up that valuable real estate on your screen, on that little compacted view that remains, there should be a hand raising button at the bottom. Can you press your hands just to make sure that I'm able to interact with you? Excellent, excellent, fantastic. That's good. So everybody knows where their hand raising button is. And then I'm going to go ahead and put your hands down now. Fantastic. Um, the scoop is I just want to know how many of you at the show of hands have actually ever heard of me before? You may know of me by the option profit success system that I keep finding on everybody's bookcase. Or you may know of me because of my activities with the Chicago Board of Options Exchange. Trading Trainer, the organization that I put together, I'm just going to give you a quick background because not many people are raising their hands saying that they know who I am. Trading Trainer was actually, I fell into it back in 2003 when I was actually trying to create a foundation for helping inner city kids not be inner city kids anymore, teaching them financial acuity, teaching them how to trade, and that gets the adrenaline rush better. Well, maybe not better than what they do on the streets, but gives them an alternative. And then I said, well, wait a second, I need to fund this foundation, and so I just created a parallel a parallel profit company. And for all these years, none of my coaches or myself have taken any wages off of our community, for-profit community. Instead, we funnel that all over to the non-for-profit. And so what's kind of cool about that is we kind of did some group stuff with the CBOE, and we've got that charity off and running. So that's kind of cool. In the meantime, that also puts us in a great place because, of course, um, we have to trade because that's the only way we're making money. We're not taking money off of this education business. So that's kind of a cool little place to be put in because we have to keep going. Otherwise, our families would starve. So with that said, quick review. I know you're all here for option trading. Let me go ahead and get my marker out because I'm going to write on this thing. We always got to refresh why we're here, especially if we're going to be talking about sideways choppy. We do the option trading. By the way, how many with the show of hands can hear me okay? Just quick check. Fantastic, fantastic. Okay, I'm going to put your hands down. So why are we doing the option trading? Option trading, of course, from the underlying symbol perspective, right? By the way, I know I keep breaking my train of thought here, but how many of you at the show of hands have your notepad ready? You're ready early in the morning to take some hardcore notes on this because I come out throwing punches here. I'm not going to be pushing products on you or anything. I want to talk about option trading, sideways choppy. Okay, fantastic. By the way, how many of you at the show of hands need a moment to grab a piece of paper and a pen? All right, you guys that have your hands up, grab that piece of paper, grab that pen, or grab that online document, and I'm going to get to it here because just they'll get too far behind. So the scoop here is, we've got strategies that profit whether the market's going up, down, sideways, right? So just, there's so many synthetic equivalencies and adjustments you can do, but the first thing you want to think about if you're thinking about a strategy or something to meet the market if it's going up, the simple thing, and I'm trying to get my drawing tool here. Give me one moment. There we go. I'm just going to draw the P&L diagram. Just a nice little long call, right? That can profit if the market's going up. How many with the show of hands agree? It's going long a call. Yeah, nice directional move. And in fact, the contrapositive is true. If you go in the down direction, yeah, just long put. You can do so many other strategies, but that's the first one that comes to mind. What if you're pretty sure that it's not going to go down, right? But you're not sure if it's going to go up or neutral. What's the first strategy that comes to your mind? Maybe a vertical spread, a bull vertical spread. I call it a bull half condor. Same thing's the truth for if you're going to be going in the down or side. You can't decide whether it's going to go down or sideways, but you're sure it's not going to go up. You'd start saying to yourself, well, what about a bear half condor or a bear vertical spread, right? And then what if you're almost positive it's not going to be going either up or down? You're pretty sure it's going to be going sideways. Well, then, of course, we put the two half condors together and we get ourselves condor. Again, there's so many synthetic equivalencies of these, but these are the first ones that come to my mind. How many with the show of hands agree so far? Excellent. Excellent. And then, of course, if you know it's not going to go sideways, but you're not sure if it's going to go up or down, we can always throw a straddle or a strangle on there. So, these are the first 6 strategies. And if you think about it, because a lot of people get kind of really overwhelmed by option trading. I don't know, last time I was reading some theoretical paper, somebody had broken the record and gotten up with like 31 different combinations of these strategies. But what I talk to my folks about is that really, what we're thinking about here is if you know inside and out the call and the put, you know how to short it, you know how to go long it. If you know inside and out a vertical spread, every other strategy, if you think about it, is really a combination of these, whether you're talking about horizontal spreads, diagonal spreads, condors, straddle strangles, even covered call writing. So long as you understand these 4, understand them inside and out. So when people say, well, I'm getting overwhelmed by the Greeks, I'm getting overwhelmed by all these different topics, I say, hey, focus on really understanding these 4, and then you'll start to learn as you apply these 4 that every other strategy is just a variation or permutation of these 4. Something to keep in mind. Hey, but let's keep on going here. We don't need to do too much review. I just want to make sure we're all on the same page, especially 9 a.m. Eastern, 6 a.m. Pacific. Let's go. The other thing that we can profit on, remember, options are multidimensional, especially when they're at the money. And this is where we start thinking about our sideways choppy market is, of course, time decay, right? And, of course, one thing we need to think about, this is a misnomer really, is time decay, because it's really theta decay. Time doesn't decay. In fact, I keep quizzing my folks. I say, listen, is a day from 120 to 119 before expiration any shorter or longer than a day that's 1 day before expiration? No, a day is a day, right? There's 60 seconds in a minute, 60 minutes in an hour, 24 hours in a day. That doesn't change. It's theta that changes, right? Theta is what exponentially increases, and it's in a negative scalar, so that means it's going to be working against you. Of course, if we're selling premium, right, then that can work for us. So we got to keep into consideration that the extrinsic value of an option at the end, no matter what it is, whether it's pumped up with IV or not, whether it's pumped up because implied volatility is high or not, at the end it's always going to be 0 days, worth 0. That's the extrinsic. The intrinsic, the value that's left over after the option expires, of course, can be rolled over, carried over to another month, or even cashed in. So there's a profit center for us if we're going sideways. I promise we'll get past the theory so far. How many with the show of hands, by the way, are following? And let me ask another question, because I sometimes am berated by comments. How many with the show of hands, especially this early in the morning, are saying I'm talking a little bit too fast? Okay. Well, I'm going to try to slow it down. I apologize. I run at Mach 5 with my hair on fire, but we'll slow it down here. All right. Plus, we've just gotten to the review here part, so let's keep going here. There's another component, isn't there? There's another component, and that's called the implied volatility, especially right now during earnings season. A lot of us are doing implied volatility trades. What the heck is implied volatility? How many with the show of hands have a good idea what implied volatility is? You think you have a good idea. By the way, if you haven't found your hand raising button, it's even if you've compacted your GoToWebinar, which I recommend, just like Kevin did, do that because it's going to free up valuable real estate. I'm about to pull out a website here and start looking at charts and stuff, so you don't want to be having this thing, especially for some reason the webinar designers put this GoToWebinar thing in the upper right-hand corner of our screens, and that's where the business end of our charts is. Oh my gosh. So collapse that down, but on the compacted view you'll see a hand raising button at the bottom. It's just a little picture of a hand. If you raise it, I can see your hand go up. Fantastic. So I got to ask the opposite. How many with the show of hands when I say implied volatility, you've heard of it, but you don't really understand it? Let's open up a CBOE chart, why don't we? Here, I'm going to bring over a browser. Maybe. There we go. I'm just going to visit. Let's just use free sites today. I'm going to go to the CBOE site. I'm just going to use their IV tool, and I'm going to put in, let's just put in Amazon, AMZN. And I'll click on this volatility chart here. I'll get a 1-year volatility chart, and I'll just view only that image. Zoom in on it so you can see what I'm going on. Listen, we got 2 lines on this, right? We got the 30-day historical volatility, right? If you imagine volatility and the 2 different ways of measuring it, historical versus implied. Historical is if you're looking out the back window of your car, right? Imagine you're driving a car. Let's actually pull up. I'm going to jump into the Trading Trainer website here. Let's go ahead and pull up a chart. This is right in our website, and I'm going to pull up Amazon again, so we're looking apples to apples. And I'm going to look at 6 months. All right, so here's a chart on Amazon, right? So we're right here, especially since the market is still 15 minutes from opening. So if you look backwards from where you are out the rear of your car and look at the implied volatility, especially like we are on this volatility graph, this other picture here, that's your historical. And in this case, we're looking at 30 days back behind us, right? So as soon as something that was volatile is 30 days behind us, like for instance, this gap, that was pretty volatile. That caused, people to get agita, right? That means upset stomach. As soon as that's 30 days past, then we see our implied volatility, right, drop back down. Because this is not volatile when we look in our rear view mirror. This is kind of calm. Everybody with me? How many with the show of hands say yeah? Now, looking forward, right? That's this yellow line or a gold line or whatever you want to call it. It's called implied volatility. All right? By the way, what is the #1 thing you have to have on an underlying symbol in order to get an implied volatility reading? How many of you with the show of hands know? Go ahead and type it into the chat box if you think you know the answer. What's the #1 thing you think you got to have in order to get an implied volatility reading. James says movement. Anybody else? I love it. Volume, price movement, volume. Let me give you a, aha, Lori. Lori, love it. Roger says velocity, but Lori is the only one so far who is spot on. You need to have an optionable underlying stock. So did Frank. Frank got it right too. If options aren't traded on it, you're not going to get an implied volatility rating. See, here's what it is. Here's what it is, and I promise I'll get onto the out of the theory in a moment here. But as you can imagine, we've got this cool thing called an option. It is traded on its own market, but yet it's linked to the underlying. So here's the scoop. Most of the purpose of options is so that the market movers, the guys who have the big money, right, can hedge their underlying symbol positions. So when they are afraid, like Amazon is going like this, they're not so afraid, but then they see in the up ahead of them is an earnings season, and they're afraid that the underlying symbol may do something squirrely, right? And so they want to hedge themselves. They may buy some calls, they may buy some puts. So if the stock moves somewhere unexpectedly, these things will reduce risk. I always love it when people say, aren't options risky? And I say, are you out of your mind? They were created to reduce risk, right? If they're used correctly. So they use these hedges, but what happens now that these guys, I call them like insurance policies, right? They're hedges. What happens if all of a sudden there's a run on these insurance policies because a bunch of these traders think that their underlying is going to go squirrely? Well, the price goes up, right? The price goes up, right? It's supply and demand of these options. So if all of a sudden all these people looking out the front of their car say, oh my gosh, up ahead is an event that could cause this price to go squirrely, I'm going to hedge. When people start buying the options, the calls and the puts, the price goes up. Basic economics. So when the price goes up, all right. So there's some mathematicians that came across, and they kind of tried to figure out a formula to model this, right? God forbid, trying to figure out human emotion in a mathematical formula. So they got the option price, and then they got in there, they're like, well, we know that there's something having to do with the time decay, right? We just showed you that picture. We know that there's something having to do with the underlying symbol price movement, but then we still can't, if we just have these two factors in there, we still can't seem to get it to work out to be what our option price is, so there must be a fudge factor. Let's call it implied volatility. We'll just put that in, but it's kind of like this ethereal, we don't know, it's just a fudge factor to make our equation work. Well, guess what? We can take the option price, remember this price that's pushed up because traders are getting excited and they're hedging and they're pushing the price up, and we can factor out this known value of time decay. We can factor out this known value of where we are with respect to our strike price, you know, the underlying symbol price, and what's left over is this pressure, this emotional component, how much we are pushing the price of the option up because we're afraid of an upcoming volatile moment. How many of you with the show of hands is this starting to make sense? So through this magical use of options, right? Let me see if I can bring back my, I gotta remember all the keystrokes. There we go. Through the magical use of options and factoring out those known values, we can see how much price pressure is being put on the options because of hedging. So that's what this implied is, right? And again, you can't tell this because they're not actually trading the underlying. Instead, they're trading these hedges. And of course, we can, you know, the mathematical equation is a little bit harder than that. And you know, they factor in all the different options in the option chain and come up with a mean and all that good stuff. And that's why they call that the IV mean. But the scoop is this is what you're seeing. As the event is getting closer, people are using more of these options as hedges, which is pushing that price up by this IV. And so, a lot of people say, well, the option price is being pushed up by implied volatility. In truth, if you think about it academically, it's actually the option price is being pushed up, and that's pushing IV up. But who cares, right? It doesn't matter. So blue, historical volatility, is looking out the rear. Yellow, implied volatility, is looking out the front. Now, I've done a study over the last 12 years that I've really been focused on this, and I have found that a lot of the market movers who do this, they push the price of the options up, right? And as soon as the earnings or whatever the event is released, they're like, okay, I don't need the hedges anymore, and they offload them as quickly as possible. Rob, spot on with the comment, Black Scholes. That's exactly who the mathematicians were. They're oftentimes, with how much they bid up the options, expecting this volatile thing, they're oftentimes, and I come out with a number about 63% of the time, they over-exaggerate. They buy these hedges as insurance, and then it winds up not to be necessary, especially the guys that come in at the end and pay the top dollar for the hedges. They rarely make their money back after the price collapses. But this gives us an opportunity to be able to sell premium on an earnings event. Again, whatever the premium is, we can do condors, we can do calendar spreads, we can do whatever we want, diagonal spreads, whatever it is to sell the extrinsic value, we can profit on the IV drop. Now, one last thing to keep in our mind, and I hope this is a good kind of refresher, because I bet you that the rest of the guys today will be building off of this. There we go. So back to this time chart. So the time chart is probably the most reliable variable, I would say, of the option price, right? Because the component that has to do with the underlying symbol, well, it depends on the underlying symbol. So that gets into all the factors around chart reading, making sure you have a good confidence about where the underlying symbol is going to go. And so that, has its uncertainties in it. And implied volatility, of course, you're going on the emotions of what these folks are going to be thinking is happening in the future. And so that's, you can use things like mean reversion. In fact, I was on a YouTube video call, a radio call, I don't know, YouTube show call on Monday, and one of the other traders was asking, one of the things I think is my weakest is being able to forecast with any confidence what's going to happen with IV. And the rest of us said, yeah, we all are there, right? You can use mean reversion, you can use topping out, you can use overpriced, underpriced compared to historical, but those are some unpredictable. Time value is fairly predictable, because last time I checked, 1 second that goes by is going to be 1 second. What does that mean? Keep this in mind. If you have something that's really reliable, like take, for instance, putting your money into the safety of a savings bond, that's really reliable. What do you get in return? There's always a trade-off, risk versus reward. If it's really reliable, meaning there's less risk, probably your reward's going to go a lot less. So if what you're trading is time decay, your returns might not be up there, but your risk will be perhaps lower. But if you're trading things like IV, where you're putting a lot of ideas into what's going to happen with the implied volatility charts, your return potential is very high, but your risk is, So one of the key things that you have to keep in mind, always, 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 please write this down in your notes, is balance risk before looking at reward. Balance risk before looking at reward. In other words, on all of these option strategies, we can forecast out a scenario of risk and reward. Once you have a risk for a simulated position, then calculate your position sizing, right? How much risk will you let your portfolio take in one given trade, I usually like to say about 2%. And so if you've got in your scenario, a risk of 10%, well, then you're only going to put, no more than 20% of your portfolio into that. Position sizing, money management. We're in here for the long run, aren't we? We don't want to blow it all on a single trade. In fact, we know even if we do everything right, that we could have a losing trade. Beware of folks that say they have a 100% win ratio, right? So you're going to have losing trades, but the key is I could have a 50-50. I could even lose 60% of the time, but because of my money management rules, even with options, I'm going to come out at the end of the month, end of the year, way ahead. So keep that in mind, right? We can calculate our risk on every single one of these positions, and then we can do our position sizing. So you'll find that because the risk is typically lower, and so is the reward, on your theta decay positions, you might have a larger part of your portfolio into them, whereas your implied volatility or your positions based on the movement of the underlying or the movement of the implied volatility might be smaller positions, but pay back nice. Now listen, I've studied, because it's about 9 years now that I've been interviewing other traders, like the folks that are on the phone. In fact, some of the folks on the phone after me have been interviewed with me. I've been trying to put together a book, but I never get around to finish writing it. But I've been trying to figure out the common theme. And so I've talked to not just option traders, but all kinds of traders. And hey, when I talk to a successful trader, this is what I find out that they all do. So you might want to mirror this. Number one, they look at things first from pattern recognition. They look at all the patterns that they can recognize. And then, whether it's trading foreign currencies, trading commodities, trading futures, trading E-minis, trading indexes, stocks, options, they then look for the right pattern matching strategy. What I like about options is you saw the flexibility of them on the last 3 slides, what we talked about. Good question by Mr. Bell. I'm going to stop right here and just answer his question. Do you calculate your risk as the max loss or where you're placing your stop loss? You do it on where you're placing your stop loss, where you're going to bail. Okay? Where you're going to bail. Good question. All right, so coming back here, pattern recognition, pattern utilization. They don't mix it up. When I find traders who are not being successful at trading, I find that perhaps they're jumping at how can I profit off of this before they've fully recognized all the patterns. That can be a sheer sign of trouble. So let me show you what we do here at Trading Trainer, and I'd like you, if you want, listen to it, perhaps mirror it. We take everything from our underlying symbols, we throw it in the top of a funnel. We use a fundamentals and pattern and liquidity filter to create for ourselves our watch list. From our watch list, we use a once-a-week manual naked chart analysis combined with some algorithms that are pre-built into some tools, but you can also use those algorithms manual. What we like to do, of course, is accelerate everything so that we don't have to spend our entire life creating a job out of this trading. And we get a pick list every evening of what we're going to pursue, what we're going to research further, and from there we'll finally get to pulling up the price charts, the point and figure charts, the volatility graphs, the volatility skew graphs, and we'll do some validations, because what we're going to come out with is a hot list pick. These are the picks that I'm willing at that evening, and of course this is all an end of day practice. I'm willing to take money out of my wallet and put down the next trading day if the follow-through rules are met. And I want to emphasize this component here. Once you've recognized a chart pattern, recognized a volatility graph pattern, you want to apply tests to it to validate it. And not only will this tell you whether or not that pattern is true, exists, but it'll also help you determine a confidence. Because at the end of this pattern recognition stage, and I want to change my color because writing in black doesn't do it for me. How about writing in red? I like that. So at the end of this pattern recognition phase, not only do you want to say, hey, I'm in a sideways choppy market, or I'm in a sideways consolidating market, hey, implied volatility is going up, you also want to assign a confidence. Some people use 0 to 10. Some people use 0 to 100%. I like to use percentages. So I'll say, am I 80% confident, 90% confident, especially with options trading, and I'll tell you why. Because when we scooch over here to pattern utilization, again, what I like about options trading is no matter what the market throws at me, like right now, again, I told you I was on that call with those other traders on Monday, and I was the only option trader, and they all, at the end of the call, you know, they were asked, what are you doing next week? What are you doing for the week, trading-wise? And they all said, I'm sitting on my hands waiting for patterns to develop. What they mean is they're sitting on their hands waiting for patterns that they can trade to develop. Then they got to me, and I said, well, I'm going to be trading my ass off. Oh, I'm going to be trading my rear end off because I'm going to use some sideways choppy strategies. And they said, you option traders, right? So when it comes to pattern utilization, once we have what we recognize and it's been validated and we have a confidence level around it, we're going to pick the correct option strategy and the correct options to populate that strategy. We're going to calculate our simulated risk, our scenario risk, do our position sizing. We're going to craft some follow-through rules. This is all done end of day, by the way. I like to do my stuff when the pressure of the market is not happening. Craft for us some black and white follow-through rules so that when it is market time, we can look down on our piece of paper, look on our computer screen and follow these rules and not get caught up in the emotion. And then ultimately we'll do our entry. If we carry our positions multiple days, we'll do position management at the end of every day, and ultimately we'll exit. But the key here, not to de-emphasize, because it is, in my mind, besides the factoring out the emotions in your trading, which I try to do because I'm a really emotional Italian-American dude, you'd say, gosh, how did that happen with a last name like Brown? Don't ask. But, you know, what we're talking about here that really gets us going is option strategy and which options do we populate with. So let's get into the actual discussion about sideways choppy. Thanks for the primer. I got 9 tests for you to write down. And by the way, I'm squeezing today's 1-hour call. This is usually a weekend, if not a whole week intensive seminar. So we'll get naked chart analysis. You heard me talk about this earlier. What I do is I pull up a 6-month daily chart. Usually I use open, high, low, close bars. Sometimes line on close. Maybe I'll have volume, but nothing else. So that's why it's called naked. No indicators, nothing to distract me. And I'm going to review my watch list once a week, looking at this naked chart. I'm going to group it into 3 patterns, okay? Am I testing a trend? Am I reversing on a trend? And am I going sideways? Or is it a not tradable pattern? So there's 4. One of them is not tradable. And I'm going to go through my watch list. I'm actually not going to spend any more than about 20 seconds looking at any one chart. I do this on the weekend. And I'm going to be able to group. And not only will you be able to look at individual tickers and say, okay, I know what I'm going to do with this particular ticker, but at the same time, when you look at it from a 100,000 foot level, you're going to be able to see, oh my gosh, the overall broad market is going sideways choppy like we are right now. Okay, naked chart analysis. Bollinger Bandwidth. So I like to look at the Bollinger Bandwidth. How wide is it? How low? How tight is it? When we're looking at sideways choppy, we actually want to see this kind of be on the higher side. I actually like to look back 6 months. I have a little algorithm that runs, looks back 6 months, and creates a scale from 0 to 10 and set, based on the action over the last 6 months. And it'll tell me if it's a 1, it's very small. If it's 10, it's very wide. How wide are the Bollinger Bands? How about the candlestick count? If I've got candlestick bars in that channel, we're talking price charts here. In fact, let's go back. That's what we're doing right here. This is Amazon again. So this is a wide Bollinger Band. This is a tight Bollinger Band, okay? All right. If it's sideways channeling, I would want to see it be on the wider side. Not so wide, but on the wider side, right? Sorry. Candlestick count, how many candles are inside those Bollinger Bands? I'm not talking about the wicks, I'm talking about the candle bodies. The bigger, the larger the number, the better for sideways choppy, right? Again, I'm helping you identify the perfect underlying symbol to be trading some sideways choppy strategies on. I call the butterfly pattern, not to be confused with the butterfly trading strategy. Butterfly pattern is just the 5, the 10, and the 20-day exponential moving averages. And are they converging on a butterfly body? Or are they flip-flopping past each other? I prefer, for a sideways choppy, flip-flopping past each other. When I see consolidation, I'm thinking break. I'm not thinking trading premium against. Okay. Of course, support and resistance lines. How tested is support? How tested is resistance? In fact, instead of looking at Amazon, how about we look at something like the spiders, SPY. Okay. How tested is our level of support? How tested is our level of resistance? Fractal patterns. Love me some fractal patterns. Let's go back in time, shall we? Not just looking at 6-month daily charts, but let's look at 2-year weekly charts. Are we seeing the same pattern? Are we looking at 10-year monthly charts? Are we seeing the same pattern? How many with the show of hands can hear me okay? Good. All right. So fractal patterns. How about looking at, for instance, Kohl's? This is a 10-year chart on Kohl's. Kohl's just started to break, but 10-year chart, monthly. Let's look at a weekly chart. 6-month. Not 6-month. 2 years. Write these numbers down. 10-year monthly, 2-year weekly, and then 6-month daily. In fact, you could even go down and look at a 30-minute bar. Don't look at 60-minute bars. Not when you're doing options trading, because the market has got an odd bar. The market's open from 9:30 to 4. 30-minute bars. Or 78-minute bars if you can program it in. Don't use 60-minute bars. Okay? So you can get an idea of if this thing's been sideways moving for a while. Fractal patterns. Again, you don't have to meet all of these tests, but this helps you build that confidence. Point and figure analysis, one of my favorites. And again, let's use as many free sites as we can. So let's go visit the folks that have a nice free tool at stockcharts.com. And they have a nice little point and figure tool. So here's the S&P 500. In fact, one of the things I like to do on their tool is on their overlays, I can do a little quantitative analysis of sorts, price by volume. And so not only do we get to see where the reversals happen, I was talking about that heavy level of resistance, but we can also see how much volume has been traded there, right? Help us understand what's really support and resistance. I love point and figure charts, by the way. Remember, point and figure charts are not by time. Point and figure charts, each increment to the right is when there's a reversal. So it helps us understand very quickly support and resistance lines, right? You can validate the support and resistance lines you saw on the price and volume chart. Here's a good one. Please write this down. Channel width versus average channel price. So once you've got your support and resistance, see if I can get my pen up. By the way, how many of you with the show of hands are following? Following along, taking lots of notes? I see a lot of people saying, will this be recorded? Yeah, it's being recorded. Have to watch it in slow speed, I guess. You got your support and resistance lines. So let's measure the width. So say, for instance, we decided resistance was at $100, support was at $90. What's our width going to be? $10. And then determine the channel's average price. So in this case, 100 plus 90 is 190, divided by 2 is 95. The average price, the mean price, 95. So let's create a ratio of the width to the average price. 10 over 95. Pull up my calculator, because I can't do that in my head. Trying to figure out where my calculator went. Well, it's about 10 over 95. It's about 12%, 11%, something like that. There it is. Came up a couple times. I guess my computer's run a little bit slow. Came up 3 times. 10 divided by 95. About 10.5%. So a good number for a sideways channeling is between 10 and 20%. Less than 10%, again, you're starting to worry about it breaking on you. And one of the things when we're selling premium in order to make profits off of sideways channeling is you can't have it break across the strike prices. Okay? So we want to make sure it's going to be sideways channeling. It's going to be sideways channeling for a while. So between 10 and 20%. Okay, last one. Look at the company and see if they're giving out dividends. Turns out, people put in their mindset that if a company's giving out dividends, it's an income generating company versus a growth company. That's not always the rule, but you'll see a lot of dividend companies, people just invest in them to make the dividends. So if a company's issuing dividends, you might say, okay, that's more of a reason to believe that it's going to stay sideways channeling. Okay, so 9 tests that can help us build that confidence. If it passes all 9 of these tests, you might say, hey, I'm 100%, 80% confident. If it only passes a few of these, less confident, right? All right, so let's talk about some strategies. How are we going to trade these things? I guess oh, by the way, I have a list of some candidates for you to check out. I want you to check out Agrium, Amazon, Boeing, Deere, eBay, Google, Tesla, and Yum Brands. Oops. Let me leave that up there so you can write those down. Just write down the tickers because Motormouth over here has only 15 minutes left. Agrium, Amazon, Boeing, Deere, eBay, Google, Tesla, Yum. Look at those for sideways channeling opportunities. There's more, but this is off of our watch list and using our tools. All right. So let's use a half condor. That's my nickname for a vertical spread that's optimized for theta decay, which basically means it's a near-term vertical spread, meaning our options are expiring. In this case, it means that it's expiring for the third Friday of May. Got a good question from Mike. Mike's asking, what about small cap companies? Listen, Mike, when you're, again, the way that my filtering works to get people on the watch list, small cap companies, for me, tend to create unexpected volatility. Again, not something I want to be surprised with, especially selling premium against it. So I pass on that. Plus, for me personally, there's not enough liquidity. And it's another reason why in only some cases in my trading weeklies right now, I got so much that I've got trading right now that I don't want to be the only one trading an option. So there you go. So let's do a vertical credit spread. And let's time it. All right. Let's not just time it based on, in fact, let's go back to our chart. Or let's go back to our website. There we go. Let's go back to here. I'm going to, let's actually pull up a candidate. I'm going to use our screener tool just to shortcut this. Again, we could do this manually, but to save time, I'm just going to use our online screener here. So I'm just going to run the report based on last night's data, last night's end of day data. And so here's the Bollinger Band with index. Here's the bar counter. So let's go and find something that's got a large bar counter, but is also got a large sideways motion here. Let's look at Tiffany. Tiffany's got a 7 and a 31. That means 31 days inside the Bollinger Bands. The Bollinger Bands are 7. Let's go ahead and plot this thing. So again, I'm going to plot it with the Bollinger Bands, the candlestick counts, all that good stuff. All right, so here's Tiffany. This is a 3-month chart on Tiffany. It's trading between 85 and 90. So that's, if you take our little equation just off the top of your head, if it's between 85 and 90, maybe it's a little bit lower, something like 83 and 90. That's going to be $7 divided by, if you take 83 and 90 and take the average of that, that's about 86.50. So that's about 8%. So maybe Tiffany wouldn't be, or I wouldn't give it the highest confidence because it could break at any time. But with that said, if we were going to trade it and we're watching it, you notice that, you know, over a month's period, it bounces down at support. It reliably goes up to resistance. It comes down to support. So here's what I want to do with my half condors. I want to time them. I want to time them such that I've bounced off the bottom and I'm on my way up. You know, we can use a combination of a price threshold. Maybe we throw our Fibonacci price retracement lines on there and we say, hey, we want to go up 1 retracement, and combine that with a lagging indicator like maybe a 3 and a 5-day simple moving average. See those 2 signals to prove that you've hit the bottom and you're on your way up. That'll get us the best price for our condor, half condor, and it'll go up. So that's kind of the strategy I'd like to do. I don't want to just place an iron condor on this thing. I want to get the best price for my half condors. Go in and up, and just leg in and out of these things. Sometimes I'll be in a full condor, sometimes I'll be out of everything. But I have found by actually legging into these using half condors that you're going to increase your returns versus just throwing an iron condor on there by as much as 2 to 3 times. Okay? So that's strategy number 1. Strategy number 2, let's put some automatic adjustments on there. In other words, when we place that trade, let's place a smaller position trade up at resistance of a butterfly strategy. Just a small position that as we go up, that butterfly is going to appreciate drastically. And if we're going in the down direction, let's use a calendar spread to catch the price as it comes down. Much smaller. I'd go into details, but again, I'm running out of time, so just copy that down. We're going to put call butterflies at resistance, put calendar spreads at support. Time it the same way. I put these on automatically. The half condor is a much larger position. This just adds a little bump to the returns. Using a calendar spread is a great way to profit on a sideways choppy movement. Have the front month be near term. Place it when we're in the center of the channel. Also, you never know when it's going to break out of that channel, especially if you're following something like that Tiffany where we're starting to get even more range contraction. So let's put a straddle or strangle. Now here's a quick thing, and I think I'll stop here, and then I'll. The scoop behind this is with a straddle or strangle. Remember our implied volatility graph? Let's place our straddle or strangle far enough ahead of the event that we're low on the IV. That means we're buying the underlying, or we're buying the option chains at as low a price as we can, so that as time passes by and the theta decay kicks in, it can be balanced by the IV move. Whoa. In fact, if we use, put this down in your notes because this is going to be the last topic of the day. If we use farther out in time options in our straddle or strangle, we're going to minimize the theta decay, right? Farther out in time options don't decay in price as fast. And we're going to maximize this other Greek term called vega, which is how much this IV change affects option price. Go farther out in time. The IV going up will have a greater impact on the price of the option than the time passing by. So you can get a balance going on. In fact, a lot of times, the IV change will have a more positive move on the stock or on the option chain than the theta decay. You don't even need it to break. The break would be frosting on the cake. Listen, I'm full of these strategies. These are 4 that are going to get you really going nicely. Listen, I want to give you a little, I want to let you, if you guys are interested in working in my community, just very quick, we only got 4 minutes here, so I don't want, again, I promised you, by the way, how many of you with the show of hands picked up something today that you didn't know before? Excellent, excellent. How many with the show of hands picked up something that you knew before, but now you know how to use it a little bit better? Oh, man, that's awesome. And how many of you with the show of hands just enjoyed yourself for the first hour? Oh, I like that. Chris just said, I knew it, but this was really helpful. All right, so this is what we're going to do here. So I got this thing, and I just threw it together. Let's see if I can get my computer to kick up here. we threw all this stuff together. I'm going to send you a DVD that gets you started. Make sure you know what you're talking about. Get you Learning Center access. You can work with us. That thing that Kevin talked about that I do every night, my recommendations, get our tools, all of that stuff. And I am going to make it all free except the DVD. In fact, even on the DVD, I'm going to reduce the price to just 97 bucks. So if you want to get started with us, come in for 97 bucks. Now I do have to tell you that after 21 days, you can of course cancel at any time during that 21 days. And of course the DVD is yours to stay, and you can take any of the information out of the web portal that you want during that 21 days. After that, I got to charge you for all the, we have 9 different data feeds coming into that web portal to power all the tools and get you everything so that it's a one-stop shop. So that's $99 a month starting on day 21. Until then, you can, feel free to take as much as you want. $97 will send you that DVD. And to do that, you just have to go to www.realtraderswebinar.com/TT. Now there's about 300 people active, and there's over 1,500 people in our community right now. And we've got groups going. I got 2 minutes to show you this. If I can get the right slide up. Not the slide, the website. We've got groups. Folks are meeting, talking about their trading nonstop, checking. One of the things I have found about pattern recognition is one of the best ways to validate a pattern is have another set of eyes, or 3 or 4. We got all our tools. We've got all the updates that we make at the end of the day, including me making videos of what I'm trading, so you can look over my shoulder and see exactly what I'm doing. And of course, a ton of material, about 500 hours of videos and stuff that you can, it's all keyword searched. So anyway, it's the end of my time. Please consider joining us here at Trading Trainer if you'd like. Otherwise, definitely watch the replay. I hope you can pull something out of it. If you'd like to get a hold of me, write down my email address. I answer my emails, maybe not so quickly, but I always answer them. And you can always give me a call, 970-266-8146. I'm an extension 81, aj@tradingtrainer.com. Otherwise, please, realtraderswebinar.com/TT. Thanks, Kevin.